Hi, I'm Champion Trader Kevin Davey, and today I'm going to talk to you about the best trading secret I know. Shh, don't tell anybody. But let's get started. I'm going to talk about the big secret in trading. And I'm going to start out by telling you what the secret is not, because there's a lot of misconceptions out there. Then I'll do the big reveal. What is that secret? Shh. Why do so few people talk about it? What does it look like in action? And how can you ensure that you're using it correctly? Because that's the important part. So with that, let's jump into it. So many people think the big secret is entries. Oh, you got to have the right entry. If you enter at the right time, everything else is taken care of. That's the secret. That's probably the most common answer. And that is not true at all. Yeah, the entry is important, but that's not the secret that I'm talking about. And, the flip side, people think, oh, it's not when you get in, it's when you exit. And people have done studies where they show, oh, if you exit at the right time, you can make money with a random entry strategy. I don't know if that's really true or not. I don't think it is, based on what I've looked at. But finding the right exit is not the secret to good trading. And then finally, a lot of people think, well, hey, position sizing, money management, that's the way to go. As long as you do that right, everything else takes care of itself. And it's important. Just like entries are important, just like exits are important, but it's not the secret I'm talking about. But we're getting closer. The secret is diversification. And what I mean by that is trading multiple strategies. And what's interesting is obviously each strategy has an entry, exit, and position sizing. So by default, they become part of the secret, but it's really diversifying. It's not just trading one strategy, it's trading a whole basket of strategies and in different markets. That is the key. And why? Why is that? Well, here's an example. The light blue curve is a strategy for one market, and the dark blue curve is a strategy for a different market. And the pink curve is what happens when you add those two together. And you can see the profits add up, and it becomes a little smoother than each one by itself. And that's because the strategies are uncorrelated. And that's the key with diversification. And you can keep going and try 5, 6, 10 decent strategies traded together, and you get smoother equity curves. And that's the real reason why diversification works, because uncorrelated strategies tend to balance each other out. So how can you get it? Well, you mix up your trading. You have different markets that you trade. You have different entries. You have different exits, different bar sizes that you're looking at, different styles of trading. The list goes on and on. But the point is, you don't want any two strategies to be exactly the same, because those would be totally correlated, right? So that's what you want to get away from. And the more unique each strategy is with its market and everything, the less chance you have for correlation. And that's really the key. So why? Why should you do this? Well, a lot of people, myself included, when I first started trading, I was looking for what I called the Holy Grail. I was looking for a strategy that worked in every single market, every single bar size, and just gave me great results no matter what. And the bad part is those don't exist. Okay? It's a myth. A lot of people like to think it is there, and a lot of people like to sell you that, and it sounds enticing, but it doesn't exist. What I've found, it's much better to take 5, 10, 20 strategies that aren't perfect by themselves And when you combine them together, that's when the magic happens. That's much better than looking for one perfect strategy. But not a lot of people talk about this, and especially in trading education. You won't hear a lot of trading educators talking about how great diversification is and why. Well, there's a few reasons. One, a lot of traders just starting out have limited capital. So trading a diversified portfolio is kind of hard for the little guy. And you need to have a lot of different strategies. You can get it with as little as 2, but 5 to 10 is a good number to at least start with. And most people just don't have enough money to trade different markets like that. Now the micros, the micro ES, and then now micro crude oil, and there's going to be more micros coming out. That helps because it lowers the account size that you need to trade these micros. So it is getting a little bit easier for the little guy, but in general, trading a lot of strategies is tough. And that's why a lot of trading vendors don't really promote this. That's why a lot of people don't really talk about it. And then the second thing with these vendors, it's hard to sell a magic indicator when you're also trying to promote diversification, because what a lot of vendors do is they have one system and they say, oh, it works everywhere. It works on all markets, all bar sizes, which is a complete joke. But that's what they'll try to do. It hurts them to say, well, my strategy's not perfect, so you want to trade 4 or 5 other strategies at the same time. It makes his sales job a lot harder, right? Because he wants you to think his strategy is the end all and the be all. And when it is, and when you think it is, then you're going to buy it. But if you think you need his strategy plus some other ones, you're less likely to buy. But the fact is, one strategy alone almost never gets you where you want to be. You want to have multiple strategies. So that makes it hard for vendors to sell. And along those lines, those vendors selling those perfect systems with those perfect looking equity curves, they can argue, hey, you don't need diversification. You just trade my system and you're going to make all the money you want. That should be a red flag, because anybody that says, hey, you only need one strategy, if that strategy does good, yeah, you're going to do good. But if it does bad, you're history. And that's what you don't want as a responsible trader. You don't want to put all your eggs in one basket, right? So in this case, you'd actually only have one egg. You don't want to put one egg in one basket. You want to put multiple eggs in multiple baskets, and then the chances of all the eggs breaking is pretty small. So vendors don't like talking about diversification. And add in its advanced concept. People are looking for one strategy that's going to make them millionaires. And a lot of people are just looking for quick answers. They don't want to have to think about, oh, I'm going to have to create strategies, and I'm going to have to create a dozen strategies. A lot of people don't like thinking about that. So they kind of ignore it. But diversification's a pretty advanced concept, but it does work. And like I said, it's the closest thing to a holy grail I've ever seen in trading. And here's an example. Here's a gold strategy and a euro strategy. And you take them by themselves, they're pretty good as far as profit and as far as profit to drawdown. But when you add them, and here's their equity curves, but when you add them together, that's where it's great. Your max drawdown is actually less now than trading either one by itself, because probably what happened was when the euro was experiencing its max drawdown, gold was hitting new equity highs, or it was doing good, and so it kind of balanced each other out. And so your profit to drawdown usually goes up when you start trading more systems, and that's where you get that benefit. And you can kind of see that in this curve the pink curve because it's a little straighter. It's not as wiggly, I guess you'd call it. And that means diversification's working for you. So in this particular example, your net profit doubled, your max drawdown actually went down, and then your net profit to max drawdown ratio, which is your risk adjusted return, more than doubled. So you add all that together and hey, this diversification's a good thing. Here's another example. I showed you this chart earlier, but this is 10 decent strategies put together. And you can kind of see they still have drawdowns, but it's a pretty nice looking equity curve. But look at all the individual strategies. And you might say, those don't look so good. You know, yeah, they're all going up and they're all making money, but boy, some of them have some flat periods, some of them have some down periods. They're not what I'd call great strategies. And that's what a lot of people look to when they do their back tests, right? They look for great strategies. And probably a lot of you would dismiss most of these. But since they're uncorrelated, when you add them together, that's where they balance each other out. So all of a sudden, just good strategies as a portfolio become very good. And that's kind of interesting. And you can see that in the statistics here. The same thing I showed visually is they all have significant drawdowns, but when you add them all together, it's the drawdowns don't add up. And that's the really the key way I describe diversification. Profits add, drawdowns do not. So that's pretty neat. Now, that being said, if you had one super strategy that traded one market and you knew was going to continue to work for the next 5 years, it's better to trade just that one. But those kind of things really don't exist. So in that case, maybe it's better to concentrate on building good strategies instead of trying to perfect ones. So how do you ensure diversification? Well, you can do correlation analysis. You can look at the equity curve. You can also do Monte Carlo simulation. There's a lot of different ways you can analyze that. Another way is just to trade different markets. That almost always ensures some degree of diversification. So here are some ways to achieve diversification. So first, you could purchase a whole bunch of trading systems from a whole bunch of vendors, or maybe a whole bunch of trading systems from one vendor. You know, the problem is with most trading systems for sale, especially if you don't have real-time results to go along with it, you're just buying somebody's back test. And 90%, probably more, of back tests are junk. They're over-optimized, and you're falling for exactly what they want you to fall for. Something that looks too good to be true, and you think you're going to be able to make money with it. And a lot of people fall into the fallacy of thinking, well, I know I won't make that much money, but even if I make half of that, I'll be happy. The problem is a lot of these back tests are just fake to begin with. They're over-optimized garbage. So unless you really trust the vendor you're working with and or you have real-time results, this isn't a real good way to get diversification. Well, then you can do it yourself. You could look for systems that are out there on the internet or in trading books that are free that still work. Okay, well, you're going to spend a lot of time looking. Maybe you'll find something. Maybe you won't. I don't know. You got to look. But I don't really recommend this because I think you'll just waste a lot of time looking for free stuff, and that'll end up costing you more in the long run. Of course, you can do it yourself by just testing trading every new idea you see. You could test it or not. If you don't test it though, how do you know it really works? How do you know it improves your diversification if you just start trading it? So I don't recommend that either. So those are things I don't recommend. Now, we'll start talking about things that, hey, they could work, and I sort of recommend. So the first one, you could find a commodity trading advisor. Maybe you find a couple to divvy up your money between. These are professional money managers. Now you're going to pay a management fee, and you're going to pay probably 20% of your profits. But if you do your due diligence, especially if you spread your risk around, you might be able to have some success with this. So, I'd say this is a legitimate path for people who have the money, but maybe not the time. Yeah, you'd spend time up front to figure out which funds to invest in, but then you turn it over to professionals. So that could be a way to do it. You could also find systems on things like Striker, Collective 2, or iSystems. There's a lot of strategies out there that you can lease. Now the problem with those is a lot of times they're only there because they're performing well. So they're the survivors, and as soon as they stop performing well, you won't be able to find them as easily. Their record might still be there, it might be buried. I don't know. But a lot of this also might not be real time or real accounts. So it might be simulated trading. So you got to watch out for that. And then, of course, if you trade a whole bunch of these, your subscription costs could add up. I know somebody who was trading like 5 or 10 different systems, and he was paying over $1,000 a month just in subscription fees. And when he looked at his overall performance, he realized he was spending a lot of his profits basically on subscription fees, and it was really cutting into his annual return. So this one, if you're careful, you can do it, but just be very careful with it. Now, obviously, the way I recommend is the way I do it, and the way I teach students to do it is what I call a strategy factory, where you create your own strategies. You have a development process that works, and then you create your own trading systems. And the key there is obviously you have to have the desire to do it. You got to love this. It's a puzzle. You got to love trying to figure out the markets. And you have to have some ability, right? You have to have some basic programming skills if you're going to be creating strategies. You have to be a methodical thinker. So if you're kind of scatterbrained, some of us are, you're probably not going to do well with this, because you need to be methodical, organized, objective. But if you are, and you want to do this, this is a great way to do it, because you get to build systems that you like, that you feel confident in, and then you can check for diversification. You don't have to rely on anybody else. You rely on yourself. So people who are pretty self-reliant in their investments tend to like this road. And certainly I can help you with that by giving you a good process to develop strategies. But a lot of this is going to be on your own work. It'll be up to you to build those good strategies. But that definitely works. So kind of summing up, the key and the secret to trading, don't tell anybody, is diversification. It's not entries, not exits, not position sizing. It's trading multiple systems, multiple markets. Vendors can't really sell diversification, so they don't like to talk about it. They like to talk about their great magic system, which probably is just garbage. It's definitely possible for anybody to do, and once you get going with it, it's not as hard to implement as you might think. Yeah, creating a half dozen strategies is a little daunting at first, but if this is something you like, this is definitely something you can do. So that's the key, that's the secret to trading. It's diversification. If you like this video, please give it a thumbs up. Leave a comment. I'd love to hear what you think. Do you think something else is the key to trading? Let me know. We can discuss it in the comments. And as always, please subscribe to my channel. That'll keep me making more good videos. Thanks for watching. I'm Kevin Davey. Have a great day trading.